All right, if you care about markets, really care, stop scrolling for a second and stay with me, because something just shifted, and most people are still arguing about charts while the real catalyst already hit. Silver didn't move because traders got bored. It moved because a single policy decision just rewired how risk is being priced across the entire global system. When Donald Trump announced a 25% tariff on South Korea, that wasn't political theater. That was a structural shock. And the reason silver reacted so fast, I'm talking immediate acceleration, is because silver is telling you something about the state of the world right now that most people haven't figured out yet. Stay with me, because I'm going to show you why this isn't speculation, why it matters now, and how you can recognize this exact pattern the next time it shows up before the crowd does. If you're holding silver, watching commodities, or trying to understand what's actually driving these moves, you're in the right place. Your job is to understand the mechanism, not just follow the price. Let's break this down. Before I explain what caused this move, let me teach you something most people don't fully grasp about silver. Silver is not just a shiny metal that people trade on vibes or momentum. It lives in two worlds at the same time, and that's what makes it so reactive. It's a financial asset, yes. People buy it when they're worried about currency stability or inflation or geopolitical risk. But it's also a core industrial input. Like, we're talking essential. It goes into solar panels, electronics, medical equipment, semiconductors, batteries. That means silver reacts to two completely different forces simultaneously: fear and friction. Think of silver like a pressure gauge that's bolted onto the global economy. When trade flows smoothly, when supply chains are humming, when trust is high, silver just kind of exists in the background. It's stable. But when the system gets stressed, when trust erodes, when costs rise, when friction enters the equation, that gauge starts vibrating. It shows you the pressure before most other indicators do. And tariffs? Tariffs are friction. They slow things down. They make everything more expensive. They force companies to rethink supply chains in real time. That's why silver listens so closely when trade policy turns aggressive. It's not reacting to headlines. It's reacting to structural change. So what does that tell us? It tells us that when you see silver move hard and fast like this, you're not watching speculation. You're watching the market reprice risk based on fundamentals that just shifted under everyone's feet. Now here's what's actually happening, step by step. The tariff announcement immediately raises production costs across industries that rely on cross-border inputs. We're talking autos, electronics, pharmaceuticals, heavy manufacturing. Companies that depend on Korean imports or Korean components now face a 25% cost increase overnight. That's the primary driver. And here's the thing. Companies don't absorb those costs quietly. They can't. They pass them on to consumers, they hedge them through commodity markets, or they restructure their entire supply chain to avoid them. All three of those responses create demand pressure on materials like silver. Because if you're a manufacturer and you just got hit with a 25% tariff, you're not sitting still. You're locking in inputs. You're securing supply. You're buying forward contracts to protect yourself from even more volatility. That demand doesn't show up slowly. It shows up now. At the same time, investors are watching all of this, and they see the bigger signal. This isn't cooperative trade policy anymore. This is leverage-based policy. It's transactional. It's unpredictable. And that changes how people think about holding financial assets. That's the secondary confirmation. When you've got governments willing to deploy tariffs aggressively, it signals that the old rules, the ones based on trust and long-term relationships, are being replaced by short-term leverage plays. And when those two forces converge, higher industrial demand for silver because it's essential, plus rising demand for silver as a hedge because confidence in the system is cracking, you get acceleration, not drift. You get price discovery happening fast. Here's what's wild about this, and I need you to really hear this. Silver doesn't wait for the damage to show up in earnings reports. It doesn't wait for GDP numbers to confirm the slowdown. It front-runs the stress. It moves early because it's reacting to the policy signal and the cost pressure at the same time. That's why by the time the financial media writes the story, the move is already halfway done. But here's the part that should make you nervous if you're ignoring it. This kind of move tends to happen early, before the consensus catches up, because silver is responding to fundamentals that don't need permission from analysts or pundits. It's responding to real-world mechanics. Cost goes up, demand shifts, price follows. And if you're waiting for confirmation from CNBC or Bloomberg, or your favorite Twitter account, you're already late. The market doesn't wait for permission. It reacts to reality. Zoom out for a second, because this isn't new. This is the exact same playbook we've seen before, multiple times. Let me give you some context. During prior trade escalations, whether it was the tariff cycles in the late 2000s, supply chain shocks during geopolitical flare-ups, or periods when monetary credibility started wobbling, silver didn't spike because of hype. It surged because the system shifted from trust-based to defense-based behavior. In 2018 and 2019, when the US and China were going back and forth with tariffs, what happened? Silver went from the low teens to over $30 in less than 3 years. Why? Because every round of tariffs added friction, raised costs, and forced companies to hedge. Same pattern. In early 2022, when Russia invaded Ukraine and energy costs exploded, silver jumped again. Not because of sentiment, because supply chains fractured and manufacturers scrambled to secure inputs. Every time global trade cooperation weakens and uncertainty rises, silver reprices higher to reflect that stress. When you look at the pattern across decades, silver doesn't move randomly. It moves when the rules of engagement change. And right now, the rules are changing again. We're watching a shift from globalized cooperation to fragmented transactional trade policy. And silver is already telling you that story. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this cool off? Of course, markets don't move in straight lines. We could see profit taking. We could see a pullback. Could some of this be momentum traders piling in after the initial move? Sure, that always happens. Could this be overblown? Maybe. But here's the thing about calling this just speculation. That argument ignores the mechanism. It ignores the cost pressure that manufacturers are facing right now. It ignores the policy signal that just got sent to every CEO and supply chain manager in the world. And it ignores history. Every single time we've seen this setup, aggressive trade policy plus industrial demand for silver, the move has been real, not fake. So the smarter approach, in my view, isn't arguing about motives or trying to read Trump's mind or debating whether this is political posturing. The smarter move is watching cause and effect. Focus on what you can control. Understand why assets react, not just that they react. And let the fundamentals guide you, not the noise. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. Some of you are already holding silver. Maybe you've been stacking physical. Maybe you've got miners in your portfolio. Maybe you bought silver back when it was in the 20s, and you've been waiting for this moment. If that's you, here's what I want you to hear. This move validates your thesis, but don't get emotional about it. Don't start thinking you're a genius. Stay disciplined. Watch for policy follow-through. If Trump escalates further, if other countries retaliate, if this turns into a broader trade war, then yeah, your position has more runway. But if this is a one-off negotiating tactic and it gets walked back in a week, you need to be ready to reassess. Don't fall in love with the trade just because it's working right now. Others of you are skeptical. You're watching this video thinking, this sounds overblown. This sounds like fear-mongering. And you know what? That's fair. Skepticism is healthy. Your edge is patience. Let the data confirm the narrative. Watch industrial demand numbers. Watch trade flow data. Watch whether manufacturers actually start shifting supply chains, or if this is all just talk. Don't chase price. Wait for proof. And then there are those of you who feel like you're always late to these moves. You see silver spike, and you think, great, I missed it again. Here's the takeaway for you, and this is the most important part. Don't chase price. Learn the trigger. Learn the pattern. Because tariffs, trade stress, and confidence breakdowns don't announce themselves politely. They ripple first. They show up in commodities before they show up in headlines. And if you learn to recognize that pattern, if you train yourself to watch for policy shifts and cost pressures, you won't be late next time. You'll be early. So here's where I stand. I'm not chasing hype. I'm watching structure. Let me tell you what I'm personally watching right now. First, I'm watching whether this tariff stance expands or escalates. If Trump follows through with tariffs on other countries, if this becomes a broader shift in U.S. trade policy, that's a signal that the friction isn't temporary, it's structural. Second, I'm watching industrial demand signals tied to cost pressure. Are manufacturers actually hedging? Are they locking in silver contracts? Are we seeing volume increases in forward markets? That would confirm that this isn't just speculative. It's real-world demand responding to real-world costs. Third, I'm watching monetary credibility, because silver lives at that intersection between industrial need and financial fear. If central banks start responding to this with policy changes, if inflation expectations tick up because of tariff-driven cost increases, that adds fuel. Based on my analysis, this move wasn't emotional, it was mechanical. The fundamentals aren't breaking, they're asserting themselves. And if history rhymes, and it usually does, silver isn't done reacting. This could be the early phase of a longer repricing cycle, not a one-day spike that fades. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I just said. But if you made it this far, you're the kind of person who thinks critically and doesn't just follow the crowd. That mentality will serve you well. If this breakdown helped you understand the mechanics behind the move, not just the price action, drop a comment and let me know what you're watching. Share this with someone who needs to hear it. Subscribe if you want more analysis like this, because I'm going to keep breaking down these patterns as they develop. Stay sharp out there, think critically, verify everything, and make your own decisions.